New York. February 1950. A man sits down for dinner at a small restaurant called Major's Cabin Grill. He orders, eats, talks business, as he always does. Then the check arrives. He reaches for his wallet. It's not there. He left it in his other suit at the office. For most people, this is just an awkward 5 minutes. A little shame, a phone call, someone comes to rescue you. But those particular 5 minutes didn't stay small. That forgotten wallet would eventually rewrite how the entire world pays for things. No banks, no government program, no committee decision. One man's embarrassment became the seed of a trillion-dollar industry, the one that put a piece of plastic into almost every wallet on Earth. His name was Frank McNamara, and this is the strange, almost accidental story of how he invented the credit card and then walked away before it made him rich. To understand why that moment mattered, you need to understand something that sounds almost impossible today. In 1949, there was no such thing as a universal credit card. Not one. If you wanted to buy something on credit, you needed a personal relationship with the merchant. Your local grocer might know your face, know your family, and let you pay after payday. A department store might issue you a small metal charge plate, but it worked only in that one store. In other words, credit was local, personal, fragmented. You could be a trusted customer in one shop and a complete stranger in the next. And if you traveled for business or pleasure, it didn't matter. None of that trust traveled with you. You needed cash. Real paper money in your pocket, wherever you went. For the growing class of American businessmen in the post-war years, men who constantly ate out, traveled to meetings, entertained clients on company money, this was a real everyday headache. Carrying large amounts of cash was inconvenient and honestly, a little dangerous. So this problem remained unsolved for decades. Everyone just accepted it as normal. No one in 1949 asked, what if one card worked everywhere? It took a man forgetting his wallet to ask that question out loud. Frank X. McNamara was not a banker. He wasn't a retail magnate either. He ran a small finance company in New York, the kind that helped people and companies navigate debt and credit agreements. In other words, he understood credit better than almost anyone at that dinner table, which makes the forgotten wallet even stranger. The man who made his living studying credit was the one with no way to pay. According to Diners Club's own later account, McNamara's wife had to come to the restaurant that evening and pay the bill. Picture that scene for a second. An adult man, a credit professional, waiting at the restaurant table for his wife to rescue him. This is the kind of moment most people would just want to forget. But McNamara didn't forget it. He turned it into a question. Why should a person even have to carry cash just to prove they can spend? If a store could trust a regular customer without exchanging money, why couldn't that trust be built into something you could carry? Something that worked everywhere, not just in one store. That was the moment the idea was born. Not in a boardroom, not after months of market research, at a dinner table in awkward silence. And here is where most retellings get lazy. They say McNamara invented the card instead of cash. Technically true, but it misses the real breakthrough. By 1949, credit already existed in America, plenty of it. The real problem wasn't lack of credit, it was that credit didn't travel. Your trust with the butcher meant nothing to the tailor across the street. McNamara's insight was structural, not financial. He realized that the restaurant didn't actually need to know you personally. It only needed to trust the card. And someone else, an intermediary, could stand behind that card and guarantee it. One card, many independent businesses, one company in the middle vouching for the beer to the seller, and for the seller to the beer. This isn't a payment card, it's a payment system. And once you see it that way, you start to notice something. This is the same structural idea behind Visa, MasterCard, American Express, PayPal, and Stripe, every single one. An intermediary that takes on the risk, connects strangers who would otherwise never trust each other, and takes a small cut for making that trust possible. In 1949, sitting at that dinner table with an empty pocket, Frank McNamara had just described the architecture of modern finance. He just didn't know it yet. An idea like that doesn't build itself. McNamara needed partners, people who could turn a dinner table insight into a real company. He brought in Ralph Schneider, a lawyer, and later Alfred Bloomingdale, yes, that Bloomingdale, from the department store family. The name itself tells you how small time it was at first. Not National Credit Corporation, not Universal Payment Systems, just a club for diners. In February 1950, the same year, almost the same season as that forgotten wallet, McNamara and Schneider returned to that same Major's Cabin Grill. And this time, when the check came, McNamara paid with a small cardboard card. Diners Club would later call this moment the first supper, a joke, a nod to something much bigger. The first dinner ever paid for with what we now recognize as a credit card. Let's be honest about what that card actually was. Not plastic, not a magnetic stripe, no chip, no electronics at all. It was cardboard, a signature, and an idea that people were willing to trust. No bank behind it, no Visa, no MasterCard, they didn't exist yet. And no one in that restaurant that ordinary February evening realized they were watching the opening scene of a financial revolution. Here's the part most people skip. The launch of Diners Club was not a triumphant success from day one. Honestly, it was a little awkward, because almost nobody wanted this card. Put yourself in the restaurant owner's shoes in 1950. A man comes to your register with a piece of cardboard instead of money. Your first reaction isn't excitement, it's suspicion. And McNamara faced one of the oldest problems in business, the same one that would later haunt every platform from eBay to Uber to Airbnb. Today, economists call it the chicken and egg problem. Without restaurants willing to accept the card, no customer would have a reason to carry it. And without a critical mass of customers actually carrying the card, no restaurant had a reason to accept it. McNamara needed to solve two impossible problems at once, and it was impossible to solve one without the other already solved. So he did what any smart founder does when the big version of the idea is too hard to launch. He started small, deliberately small. According to Diners Club's official history, the very first cards went to about 200 people, friends, acquaintances, people McNamara and Schneider already knew and trusted personally. And those 200 cards were accepted at only 14 New York restaurants. 14 restaurants, 200 people. That's not a company. That's barely a rumor. But something happened inside that tiny, fragile circle of 200 people and 14 restaurants. Something McNamara probably hoped for, but couldn't guarantee. People liked it, especially businessmen. Think about who actually used this card in 1950. Not ordinary families doing weekly grocery shopping. Businessmen, men constantly traveling to meetings, dinners, entertaining clients. For them, it wasn't just a novelty. It solved a real, persistent, annoying inconvenience, not having to carry wads of cash from city to city, meeting to meeting. And here is where McNamara's real genius shows, not in the card itself, but in the business model underneath it. Diners Club didn't charge the customer for the privilege of not carrying cash, at least not primarily. It made money entirely on the other side of the table. According to Smithsonian Institution records, Diners Club would pay the restaurant the customer's bill up front, keep a discount, about 5 to 7%, and then bill the cardholder separately for the full amount. Sit with that for a second. Diners Club wasn't selling a product, and it wasn't lending money in the traditional sense. It was selling trust and charging a fee every time that trust was used. You don't need to own the restaurant. You don't need to sell food. You don't even need to hand the customer cash. You just stand in the middle of a transaction that to strangers would otherwise never trust each other to complete, and take a small cut for making it possible. That single insight, the fee for trust, is the financial DNA of almost every payment company that came after. Once that engine started turning, it turned fast. By the end of the very first year, Diners Club had grown from that initial circle of 200 friends to roughly 10,000 cardholders. The merchant side grew with it, from 14 restaurants to 28, plus to hotels now accepting the card, according to Diners Club's own history. Notice what actually happened here. This wasn't explosive viral growth. It was something more interesting, proof that the chicken and egg problem really could be solved, one small circle of trust at a time. This was no longer an experiment among friends. This was a business. A real one, with real revenue and a real working model. And this is where Frank McNamara's story should have turned into a self-made billionaire story. After all, he had just built the prototype of one of the most profitable business models in modern capitalism. But that's not what happened. And this is where the story stops being a simple success story and becomes something far more human. In 1952, just 2 years after that cardboard card first changed hands at Major's Cabin Grill, Frank McNamara sold his stake in Diners Club to his partners. He walked away, not in disgrace, not because the company was failing. He just left and went on to other projects. Think about the timing. He left right when the company was proving its model worked, right when the first real wave of growth was beginning. We don't actually know exactly why. Historical records don't give us a clear, dramatic reason. What we do know is this: McNamara never became the face of the credit card industry. He never became a household name like Steve Jobs or Jeff Bezos would decades later. He built the blueprint for a system that would eventually move trillions of dollars every year, and then he handed that blueprint to someone else and walked out the door. There's something almost poetic and almost tragic about that, depending on how you look at it. The man who solved the chicken and egg problem of trust between strangers didn't stay long enough to profit from the empire he helped set in motion. McNamara did the hardest part. In the real world, with real restaurants and real cardholders, he proved that a universal card for paying at many different businesses actually worked. And once that proof was out there, the bigger players took notice, much bigger players. In 1958, just 8 years after that first cardboard card, American Express launched its own payment card. That same year, a California bank launched something called Bank AmeriCard. Bank AmeriCard would later evolve, restructure, and eventually become what's almost certainly in your wallet right now: Visa. MasterCard followed, then came magnetic stripes, then chips, then contactless payments, then your phone became your wallet. But trace it all back, every piece of plastic, every phone tap at the checkout, oh far enough, and it leads to the same place. A small forgotten wallet, a dinner table, a man who refused to just be embarrassed and move on. McNamara didn't create Visa. He didn't create MasterCard. He never sat atop a global financial empire. But he proved the idea could work, and in the history of any industry, the person who proves an idea can work is rarely the same person who ends up running with it. So here's a question worth sitting with. How many of the systems we live inside today, the ones we assume were designed by banks, governments, careful long-term planning, actually started as someone's accident? Frank McNamara wasn't trying to reinvent global finance. He was trying to avoid the humiliation of asking a restaurant to trust him without any proof. He didn't invent the money in your wallet. He invented a way to spend money when there's no wallet at all. Frank McNamara never became a billionaire. He's barely remembered outside of financial history books. But almost every card in almost every wallet on this planet, in some small way, still pays tribute to that one awkward moment when a man had nothing to pay with and decided that should never happen to anyone else. The official Diners Club story says that in 1949 McNamara forgot his wallet in a restaurant, and that gave birth to the universal card idea. But that version is disputed. Maddie Simmons, former PR director of Diners Club, later admitted that the dramatic forgotten wallet story was cooked up by the marketing department to draw attention to the fledgling company. Watch more stories like this on our channel.